All right, welcome back to day two for the 2021 Sofa Summit. Mark Hart, Sean Taggy here from MIP and Reedy and Company, and we have an action-packed day set up for you guys, ready to go. What are we going to talk about first?
So first off, I will be speaking today a little bit on some stats of Reading Company and MIP, where we've been and where we're going and where we are right now, our growth over the past 4 or 5 years, and also be diving into some big macroeconomic stats on Memphis, how it's appreciated and everything like that over the past few years. Then I'll be diving into the mindset of an investor, some basic principles that really help you get on your way for investing in real estate. Then also deep diving into a pro forma so you know how to analyze rental properties, whether it's our own or others. I go over all the stats and metrics, all the nerdy stuff you need to know about analyzing rental property and estimating your cash flow.
I love it. I love it. Next up, we're going to have Ryan Lee from Cashflow Tactics, and he's going to talk about the infinite banking concept. And essentially what that means is you can, one, just buy a rental property using cash you have in your checking account, or you can funnel that money through a vault and use the same money, but essentially just use it twice, use it better, more efficiently, more effectively. And he's going to just show you side by side, apples to apples comparison. And one of them is going to have a significantly higher ROI.
Yeah. Then finally, we're going to actually take you off your sofa and into Memphis. We're going through a C-class property, and we show you before, during, and after our renovation on the property. And Mark gives you some great stats and data on that submarket, that neighborhood, and we do a deep dive into that property on Marlene. So we're real excited for all of this. Guys, please get your notebooks out and also be commenting. We're going to be responding to your comments all day today. We're excited to be seeing what you have to say and your thoughts.
Yep, Ryan Lee is going to be in the chat, so if you have any questions during his talk, please ask as many comments as you have. And if you haven't done so yet, make sure to hit subscribe to that YouTube channel. We appreciate you. And
we'll see you on your way to becoming a
cash flow king. I love it.
Hey guys, Sean Taggy here. Today I'll be discussing and revisiting investing in yourself, working on your mindset, working on those little things that used over and done consistently over the course of many weeks, months, and years will help you grow your investment portfolio, increase your income, increase your happiness over time. So definitely be chiming in for the whole entire session. Real excited to be giving you some ideas on how to invest in yourself, how to grow and improve your mindset with real estate investing. Before I dive into everything like that, I just want to give you guys a quick summary of Memphis Investment Properties. So we have sold hundreds, even thousands of single family turnkey houses over the past few years and decades. In particular, I've been really tracking the data since 2016. We did about 130 flips, turnkey properties that year. And then in 17, we really bumped it up to 235. Then in 2018, 245. Then in 2019, 262. And in 2020, we had a record-breaking year of 322 single-family houses sold, all to investors like you guys watching today. Thank you so much for all of your support, guys, and trust in us. We hope we've been able to really help you out on growing your investment and really diversifying from the stock market, getting a good return and having all the advantages that real estate provides. Our goal for this year, our big aggressive goal, is to have 365 houses sold. We are off track year to date for the pace that we need to be at, but we're definitely going to be hitting 300 plus, hopefully get real close to reaching that 365 houses. A house a day is the goal. Real aggressive, and we're super excited about that one. So thank you so much yet again to everyone who's purchased a house from us or whoever will purchase a house from us. Then our in-house property management company owned by Jim Reedy and Brad Reedy, the partners of Memphis Investment Properties as well. Here's our property management. So these are houses that we're managing for other investors or our own that we own. They consist of single family houses, duplexes, and also multifamily apartment complexes, like 100-unit apartment complexes. So since 2017, we've had massive growth all the way up to today's date. So the big milestone is right a couple months into this year, we hit 3,000 doors under management, and they're all in the greater Memphis statistical area. Year to date, we're at 3,291. So just super excited about that. Yet again, grateful for everyone trusting us to help manage your properties and keep those tenants in there, screen them, get them paying, manage the maintenance and everything else on them. We also started another company last year. It's a syndication company where we find an apartment or an asset and we enact a strategy or plan to raise the value and everything like that on it. So we bought or syndicated two multifamily apartment complexes, Shelby Point Townhomes, 124 units in June of 2020. And we also purchased 128 units in October of 2020. I dive more into the details of multifamily investing in my talk in a couple days from now. So then also I wanted to give you some data on Memphis. So here is our average home price appreciation since 2016. As you can see, it was at 158,000 and we hit over the benchmark of 200,000, so 205,000 in 2020. We've had about a 4.5 increase for the past 3 years, but then last year it increased 13% and it's trailing the same amount for this year. So obviously we can't predict appreciation, but we can see where it's been and kind of guess where it's going to go. And with inventory and the market and everything that's going on, I feel it's going to keep appreciating. We're just catching up with other markets and still has a lot more room to go. And the reason why I think it has more room to go is also because rents are increasing a lot. Rents have gone up since January 2016, $672 until May of 2021 to $978. So increasing anywhere from 2.8 to 7.1%. We've had 3.1 just this year to May. So probably likely to be 6% or so this year if we keep at the same trend. And about a 5.4 appreciation average or so if you average all of this out. So real exciting there. That obviously helps your return. Like you buy a property today, it might be renting for 800. It could be renting for 825, 850 in the years to come, or maybe even 978 in a few years from then. Yet again, can't predict that, only can see the general trend of where things are going and look at the macroeconomics, which I feel Memphis is still behind on rents and can have some room to grow. So the next thing I want to just basically cover a little bit on your mindset is understanding our pro forma that we have, just understanding all the basics, where all these numbers are derived from and what they mean. So what I'd like to help you guys out with is just diving into this. So here is an example property that I have brought up here. And here's our whole entire pro forma. So I'm just going to take it line by line and help you kind of understand what each one of these lines mean. So we obviously always have a picture of the front of the property. Usually our properties are under renovation. So we'll have an under reno over there. That means that the picture probably isn't going to look like when we sell it. And then we have the address and the city, state, and zip. Then the price. And this price includes it after it's been fully renovated. So we give you a scope of work and tell you what we're going to put on it. And that is including all those repairs in there. You don't have to pay for those repairs. We do. And you can do a home inspection to verify we did all those repairs, to check all those boxes. Then we have the bed, bath, square footage, when it was built, parking. So G stands for garage, C stands for carport, 1 stands for 1 or 2 car parking. A D would stand for a driveway parking only, meaning it doesn't have parking. This one is G1 for 1 car garage. Neighborhood rating, B+. We kind of go over that rating in our map video we did on Monday. So you can watch that at your convenience. So then over here on the left column side, we have property income. So we have the target rent monthly and what it would be annually if it was all these occupied. Then we estimate on this vacancy right here, we estimate a 4% vacancy, so monthly and annually. So then our operating income is our income minus our vacancy, so $14,688. Then we have in some expenses that these are estimations. Some years are better, some years are worse. Obviously, you can estimate whatever you feel on it. This is generally what we've kind of seen over the long term of owning real estate. So management fees, that one's pretty fixed. Of gross collected rent, we charge 8% of the gross collected rent. So that is 8% of 14,688 for your management fee. Property taxes, taxes are assessed every 4 years. These are the current taxes of when the last assessment was. So 1541. Insurance, this is a quote from our insurance partner, third party partner, Lipscomb and Pitts. They give us the equation that they use. This can go up or down depending on how they've adjusted things, but pretty decently around that same amount. Repairs, so based on the age of the property, we adjust the repairs. The newer the house, the less repairs and maintenance we estimate, but a 6% maintenance for this particular property of estimated annual rent. So 6% of 15,300. And then we have an annual safety inspection, or $75 once a year. We inspect the property, make sure no pipes are leaking or bursting, and that the house is in still good shape, the tenant's taking care of it. So there's your total operating expenses we estimate, 4,381. Now we get down to kind of the math of things. So your net operating income is your operating income minus your operating expenses. So 10,307. So 14,688 minus 4,381. So this is before paying your loan, before debt service, before capital expenditures, other things like that. So your cap rate. So if you bought this property for 1,065,500, that would be your cap rate. So it's your NOI, net operating income, 10,307 divided by 165,500. So 6.23% cap rate. And then your mortgage payments, this is where we're factoring in and calculating your mortgage payments. Obviously, they can differ based on your credit score, how much you put down, everything like that. Assuming a 20% down loan amount, monthly payment at a 4% interest rate. So you'd have 33,100. We estimate some closing costs as well to pay for that loan. So $36,350 is the total cash invested. So we use this number a lot for calculating the ROI. So that's where we came up with the mortgage payments using an amortization calculator, $632 a month, $7,585 for this particular property. So your cash flow is your net operating income minus your mortgage payment. So $2,722 a year, or $227 a month. So now over here, factoring in what is your cash on cash return. So if it was levered 20% down, you would take your cash flow divided by 36,350, your initial cash invested, to give you 7.5% cash on cash ROI. The property appreciation, this is assuming if this property goes up 3% in value of 165,500, you would get $4,965 in appreciation that first year, assuming your first year, or a 13.7% ROI. That would be taking 4,965 divided by 36,500. Your mortgage principal reductions. So the first year, you are making payments of $632 a month. As you know, with an amortization schedule, a lot of that is interest, but a little bit is principal on the first years. Then as towards the tail end of the last 30 years of your amortization schedule, more of it is principal, less of it is interest. So for the worst year of principal payments, or the lowest amount of principal payments, you pay down $2,332 off the mortgage, which is 2,332 divided by 36,350. That's a 6.4% return on investment for mortgage principal paydown. Then your tax savings, here's how we're calculating that. We're just assuming you can write off all of the cash flow through other expenses, such as the operating expenses. You can depreciate the property 1/27th and a half. And we're assuming you're not a full-time real estate investor. You can consult with your accountant on that, and you actually have more tax advantages if you are a full-time real estate investor and what it takes to qualify to be categorized that according to the tax law. Consult your accountant. But assuming this is like kind of the worst tax write-offs you can get, if you're just a passive investor, which is typically most of our investors, they're not full-time in real estate. But just from the first year, you can write off all the cash flows. So you don't have to pay any money, income taxes on the money you're making, even though you are on paper. So that summarizes the tax savings ROI, basically taking $898 of your net tax return, assuming you're in a 33% tax bracket. So you take your $2,722 that you could write off, times it by 33%, because that's what you could take off your AGI, your adjusted gross income. And so you'd have $898 of tax savings, or money you don't have to pay towards taxes. Divide that by your initial cash invested, and that'd give you a 2.5% tax savings ROI year one. So putting all of this together, your total return on investment is your cash flow from the property, the appreciation the property gains just the first year, the mortgage principal reduction your property gains just the first year, assuming that will get better every year, and your tax savings that your property realizes. In the worst case scenario, the most conservative way on on writing off taxes, combining all that together, you can save net on paper, theoretically, $10,917. Divide that by 36,350, your initial cash invested, and you get a 30% year one ROI on paper. And so that's what we do. All this is summarized here on year one. And what's awesome about real estate is it gets better every year. Assuming rents keep going up every year and our rent increases are 2.5%, as you've seen before, it's much higher. And the property appreciation is 3%, as you've seen through the historical data, it's much higher. And all these other expenses, and your expenses increasing 2.5% every year. What's awesome about this is that your mortgage is fixed. It's locked in. Those payments are locked in for 30 years, but the property's appreciating, let's assume 3% year over year over year, 3% on 3%. That's where it gets really awesome, is every year this gets better and better. Now, some years it goes down because you'll have a vacancy. That's what we're assuming in here, a leasing fee for your vacancy every 3 years, which is according to just our historical trend. Tenants stay about 2.75 or 3 years. But then over the course of everything, it gets better and better each year. So this is as if you would sell it, what your ROI would be, or on paper, what your return is every year, year over year. So I just felt like sharing that pro forma. I'll dive back into my talk just to kind of help you understand what that is. All right, so now I'm going to revisit investing in yourself. So these are things, really small actionable items you can do weekly, monthly, daily, yearly, to help you really increase your ROI, increase your happiness, and help you become a better investor. So the first thing is measure your results. Warren Buffett has tracked his net worth every month forever. And obviously it's turned out really well from him. So I figured, well, I might as well be doing that to get up into the billions of dollars someday. And so here's kind of where he started out. He just started out small, but just started early and consistently investing. And so I kind of really thought, when I'm analyzing my net worth, and what you need to do is summarize each month what caused it to go up or down or stagnate, and check out your historical trends. And so one thing that I've been really tracking recently is the taxes, right? Your tax bracket. The more you make, the higher your tax bracket goes up, therefore the more you're giving. So, that's kind of the question. What is your one or two greatest expense you'll pay in your life? It's going to be taxes and also interest. So zoning in, you can focus on one of these things. How can I optimize my tax strategies? That's what the wealthy are doing, like Warren Buffett. So here's kind of a case study. I bought this apartment complex with my partners, 99 unit. I actually dive into this property later on, but I put a fraction, portion of it to buy it. I put in $121,760 into a 99 unit apartment complex. Obviously looks pretty nasty. Don't worry, we fixed it up. It looks really nice and sweet over here on the right, and pretty awesome. So obviously we increased the value, we raised rents. I dive into a lot more details on that in my other talk later on in the Sofa Summit on another day. But what is really cool is that I made a lot just on tax savings here. So let me give an example here of the power of bonus depreciation and how to reduce one of your greatest expenses you'll ever pay in your life, which is taxes. So of my $121,000 investment, I had a tax loss because we're putting repairs in this property, and a lot of them we could bonus depreciate, meaning we pay 5,000 for an HVAC, we can write almost all of that off that first year. So I got a prorated loss on this property of $67,000, 553. So assuming I was in a 35% tax bracket, I would not have to pay $23,636 into this property. So that's pretty awesome. I got a return of $23,636 net tax ROI, return, next tax savings, divided by my investment of $121,000. That's a 19.4% net tax ROI, return on investment. And that's just year one. Okay, year one alone. On year two, I had a $57,000 loss on the K1, my partnership, my pro rata portion of ownership. And assuming a 35% tax bracket, that's $20,000 in tax write-offs. So that second year, I got a 16.5 next tax ROI. So I'm just showing the power of investing in real estate, using bonus depreciation and the tax laws to your advantage by investing in real estate. The government's happy to give these incentives because they want people to create housing, to create safe, clean, and affordable housing. So that's what we did here, and we reap the benefits of doing the job the government can't take on. It's just too hard and too difficult. So they incentivize people, producers, investors to do that by creating awesome tax advantages. Plus, I still get all the other benefits of owning the real estate. We get cash flow, it appreciates over time. We added value through the repairs, we increased the rents, and we can leverage the property if we wanted to and take capital out, everything else in between. So the second thing is to, have accountability. So Pearson's law, when performance is measured, performance improves. When performance is measured and reported back, the rate of improvement accelerates. So I'd like to dive into this a little bit more, but what it's saying is, think about this. If you have to report how many push-ups you did each day, or how many calories you ate each day to lose weight, for example, just doing that to yourself, you're probably going to putter out after a couple of weeks. You're going to lose energy and focus. But let's say you have to report that to your best friend or your wife or an accountability partner. You're probably going to feel a little bit more peer pressure and have better results. So that's exactly what this is saying. When you measure it, if you just measured it on your own, it'd probably be better than just kind of mentally thinking, oh, I'm going to lose weight or I'm going to get in shape. But it becomes even more accelerated when you report it to other people. And so that's what I think it's really important to have a coach and or an accountability group or partner to help you really focus on your KPIs or your key performance indicators. And you can report daily, weekly, monthly, whatever the best cadence of accountability is. But I report daily to my group spiritually. Did I read my scriptures that day? That's my spiritual way of how I connect with myself and my higher being. Some people might be meditating or going out on a nature walk or whatever it may be. That's my spiritual though, that I want to read my scriptures every day. Physically, did I work out? I want to work out at least 30 minutes every day, skipping Sundays. And then mentally, did I read a book? I want to read a book that's going to increase my knowledge in some way, 10 to 30 minutes a day. Then socially, did I meet a new person? Did I connect with someone else to help them out to drive myself forward and drive my business forward? So I report on those every day on how I'm growing in that. And I'm telling you guys, it creates accelerated growth. I've been doing it for about 2 years, and I've definitely worked out the most I've ever worked out, read the most I've ever read. And so also with this group, hopefully you can meet up with them. I don't know how often it needs to be for you. For me, it's monthly. I have a coach and I just strategize my strengths, my weaknesses, my opportunities, and my threats. This can be someone that you pay for, you don't have to pay. It can be someone though that you pay. Yet again, when you add payments into there, that kind of increases your accountability as well, right? Because you want to have a good ROI. You want to make sure you're reporting well. So there's pros and cons to doing it either way. And that just helps me see the things I can't see on my own, the flaws that I'm making, learning from the wisdom of other people. If it's a group, they provide insight and also support to you, right? There's things that are just tough that you might just need someone just to be there for you and to help you out. So I realized that you can't do it on your own. And that's why I think reporting and then also having accountability on that accelerates your growth. Next, know your currencies. So I talked about the currencies of the wealthy. So their time, knowledge, relationships, credit, and money. So a lot of people think, well, the wealthy, they value the money the most. The wealthy do value money, but they don't see it as the end all be all. They see it as a tool to help them really get these other things. And really what they actually do is they invest or spend their money to get more time. So that way they can have better relationships or knowledge or credit or even get more money from that. So they're always focusing on these areas and how to leverage them, right? If you're going about all by yourself in real estate investing, you're going to miss out on stuff. If you don't have any relationships or any knowledge or any time to do it or any good credit or even money, it can't work out. Maybe, and you can use all of them in different combinations. Maybe you know really well how to analyze a deal or know a good market, but you don't have money. Maybe you could tie in a relationship that has money to use your knowledge to make that happen. Maybe you have time to go drive to a property and inspect it and take pictures for someone who doesn't have time for that and to be their eyes and ears, and they'll pay you money for it, or maybe get a relationship going from that. So there's lots of ways to combine these. I'm talking about real estate, but really using this for everything can really help you out. So what I think is important too is knowing what you're strong and weak at in these areas and connecting it for other people that complement your strengths and weaknesses. So Socrates, the great myth and legend, to know thyself is the beginning of wisdom. So he says, know thyself, know thine self. And I think you guys we really need to, and me especially this past year, I've been really zoning in on who I am, what I want, what I'm strong at, what I'm weak at, what I like to do, what I don't like to do, what are my things around about me. And so some things that have really helped me out is take a personality test. These two are free here, principlesu.com, that's by Ray Dalio, 16 personalities, that's a free personality test. There's lots more. I suggest taking those, or you could get predictive index if you have a someone, a coach or a mentor. That's what I've taken. And that one's not free, it costs money, but you could take one of those, and it really uses data and science, right? Other people's knowledge of narrowing down who you are, what your cores are, what you're good at, what you're not good at, what you're drawn to. And you'll be really surprised that, man, maybe what I'm doing isn't aligned with my work, isn't aligned with what my personality is best at, or vice versa. Maybe you are. So that's what you want to do, is really figure that out. So I'll be going on to a mowing the lawn story, but I wrote down, I have these 4 quadrants here. The first one here is what you're really great at and you love doing. Write down all those things. So first, what you're going to want to do is just write down every day what you're doing for like an entire week or several weeks. Write down all the things you're doing, how much time you're spending on them about. I know this takes time, but you need to know yourself, what you're doing. Be aware of that. And then put them into one of these 4 quadrants here. What you're great and love doing. Me, I love analyzing deals. I love organizing business systems and processes. I love working on my craft. What you're good at. Then the next quadrant over here is what you're good at and you like doing. Like you're not super great, but you like it. You're pretty good at it. If that brings some energy to you, you put that up there. Then there's things that you're good at, but you just hate doing it. It drains your energy. Like I can enter in data all day, but doing the same repetitive thing really tires me out. So I hate doing it, but I'm good at it. I can do it. But should I be? Is that the best use of my time, my strength? There are some people who love doing that. I know it's surprising. One of my personality actually assumes that people think like me, and that's not good. I need to assume that people don't, and they actually like doing the things I hate doing. Then there's things you're just plain old bad at and you hate doing, right? And you're just like, you probably shouldn't be touching it. And sometimes people are living in this bottom half, where really you want to be living and doing the things in your top half, and then trading it with all those currencies of the wealthy, trading it with other people to help you focus on those other things that you're great at. So this is my example. I'm good at it, but I hate doing it, is mowing my lawn. It's hot, it's sweaty. I don't enjoy driving around that thing, the lawnmower. Some people do, and that's fine. If this is for you, do it. I have a big yard though. It's like 1.5 acres. So it takes like 2 hours to edge it and mow it. So I figured I could buy a new lawnmower for $3,000, maybe even five, because I want to be really efficient and get it done quickly. But it cost me $80 to mow my lawn, and I probably mow it about 15 times a year, so 1,200 bucks. So just 2 years, I would break even just on buying a lawnmower. So I was like, okay. But then also considering it would take me 2 hours of my time to mow my lawn and edge in my yard. So that'd take 30 hours a year. So it's basically paying myself $40 an hour. Plus I have to have an investment of $3,000. Yeah, it's a decent ROI in terms of like if that was it. But what is my dollar per an hour value? Can I find other activities that have a higher dollar per an hour value? Or even just activities that I'm great and I love at and bring more happiness to me and free me up and help my mind go, where this just drags me down. So that's how sometimes, that's what you do. You trade money. That's where I traded money for time, to where I could be focusing more on my relationships or knowledge, or spending my time on other things that I'm great and I love doing. So then also with real estate investing, what gets more complex is when you're doing high level activities like real estate investing. This is definitely $1,000 or $10,000 per an hour activities. And these are the four things you need. You need the deal finder, you need a lender, a contractor, and a property manager to really be doing well at passively investing. So you yourself could go find all four of these people and train them and teach them, or do it all yourself, right? Kind of like my lawnmower example. You can save yourself some money. I mean, a lot of these people, they do charge a lot of money, 75, 100, $1,000 an hour sometimes. So you could go and create another job for yourself. And maybe it is good for you. Maybe if you're only making $20 an hour, that would be a good idea. But if you're making more, or if you're not great at it, or if you don't like doing it, you can go ahead and find someone to do that, to do each one of these things for you. And that's what we have done here at Memphis Investment Properties. You hire us, and we actually line you up with all four of these. We renovate the property, we find the property, we manage it, and we have lenders for you that are in this Sofa Summit teaching you about all this. So my dad told me when I was little several times, leverage your time, leverage your money. Really consider if that is worth it for you. If it is, great, go and find those people or go and do it yourself. But if it's not, according to those four quadrants and what Socrates is saying, know thyself, I suggest finding someone to delegate it down to. So lastly is awareness. This is something I've been really working on and understanding a lot in the past couple of years. Yet again from Socrates, to know thyself is the beginning of wisdom. So awareness is the state of being conscious of something. More specifically, it is the ability to directly know and perceive, to feel, or to be cognizant of events. So being aware of your emotions, your thoughts, your biases, your actions, your words, your habits, and your feelings. Some people, like, I don't know, just for an example, I'm using some people, when they're overweight, they don't realize how many calories they're eating a day, or how little they're exercising and how long they've been doing it for. Some people who are ill-tempered don't realize the words they're saying. They just get into autopilot. So they're not being aware, is in other words of what I'm saying here. So really researching this and studying this, people who are aware are happier. They're better to be around. They have fulfilling lives, right? This is a great return, and this is a great way to invest in yourself, is understanding your awareness of who you are. Yet again, like with your personality test, you can figure out your tendencies and your weaknesses and know how to counteract them. So self-awareness is the ability to focus on yourself and how your actions, thoughts, or emotions do or don't align with your internal standards. If you're highly self-aware, you can objectively evaluate yourself, manage your emotions, align your behavior with your values, and understand correctly how others perceive you. So I have over here a feeling wheel. And first off, I didn't even know there are this many emotions. Like if I asked you right now, without looking at this feeling wheel, how many emotions can you name? Go ahead and pause or try to write down some, but there are hundreds of emotions and sub-emotions and sub-emotions. So, like for example, let's say you tended to get angry or frustrated about things or depressed or whatever it may be. It's good to know when you are that way, why you're acting that way, what situations cause you to act and feel that way, and at what intensity, at 1 through 10 on those emotions. And that helps you prepare. And then you think of ways to, hey, when this event comes up, how can I react better? And that way you'll be more aware and self-aware in the moment. So that's what I'm saying. Journaling, self-awareness, this is great stuff to be working on. So self-awareness will help you become a happier, more productive employee and leader, and can help you align your current life with your passions. So that's written by Caroline Forsey. So according to Dr. Urich, his extensive research on self-awareness of thousands of people over several years, there are two types of people. Those who think they're self-aware, 95% of people think they're aware. First off, if you can't name more than 5 or 10 emotions, you might not be super aware of your emotions. And those who actually are, 10 to 15% of people are truly like present and aware of their words and their actions and their thoughts and their habits and their emotions, and truly understanding who they are, what their purpose is, and where they're going, and that if they're aligned or not with their values, and knowing what their values are first off, and seeing that they're doing those every day. So what I'm saying here is these suggestions that I have, especially with the accountability group and the journaling, by small and simple things are great things brought to pass. When I came to Memphis, I was looking for some rental properties. I was buying out of state, and I went through one of the properties, and there was an acorn right here. Here's the acorn I collected back in 2016. And it just made me think, hey, I'm planting the seed today. I'm aligning my core. I was finding my core 4 and buying some rental properties in 2016, and it'll grow, right? It'll start to germinate, get root, and eventually I'll get some leaves, maybe some twigs and branches, but eventually it'll grow into a mighty oak tree. This investing that I'm doing. That also involves the other habits that you're developing daily. Are you doing them? Are you aware of how often or not you're doing them? So that's why having other people in can help you do that when you're reporting it to them. So by small and simple things are great things brought to pass. That's why I really challenge you to report daily, weekly, monthly, your key performance indicators, spiritually, physically, mentally, and socially, whatever else you want to develop, financially, however else you want to put them. Discover what they are, what you want to be doing every day. That's going to really align with your values. Find someone to report those to and do it. It's really going to leave you being more aware of how well or not you're doing on that. And no harm either way. It's just good to know. That's one thing too, is your self-judgment and shame and everything like that. You can just figure that out and just know, oh, hey, this is where I'm at. That's not where I want to be. I'm going to adjust, and how you can. Then another challenge is to write down, journal all this, track this, write down 10 feelings for different situations. Let's say you had an argument with someone. Write down how you felt. I felt angry, bitter, violated, humiliated, ridiculed, disrespected, weak, insecure, anxious. Know what those are, and get curious why you felt that. Does that really, is that really the truth? Is that just your bias that you have? And that really helps you discover who you are and why you're feeling a certain way, and helps you really be more calm and present in the moment and to know yourself. Then journal also what you're grateful for that day. Obviously, you need to be writing down 3 things every day. There's lots of science on that, how to feel happier. Then also report, did I do my spiritual for the day? Did I do my workout or my physical activity, my mental, my social activity for the day? And I write that down on a journal. I snap a pic of that, send it to my accountability group, and it really helps me out. I report that also to my coach. So in summary, to work on your mindset and invest in yourself, 1, measure your results, track your net worth every month, know why it's going up, why it's going down, and focus on the key areas to increase it more. Me, this past year has been focusing on the tax advantages I can take and the capital I have to optimize those in the best tax advantage real estate I can invest in, or investments. Next, accountability, right? You need to measure your performance to yourself, but then also report those results to someone else, and preferably someone who can be firm but also loving with you at the same time. A velvet glove, right? Iron fist and a velvet glove. Know your currencies. Know those relationships, the time, your money, your wealth, your knowledge, your credit you can use, and know yourself. Take a personality test. Discover what you're great at. Discover what you're good, what you hate, what you like, what you're bad at. Be honest with yourself and try to change it to what you're great at and you love. Leverage your time, leverage your money. Find those key people that can really help you grow to the next level, and use that. Lastly, take action and believe. By small and simple things are great things brought to pass. What seeds are you planting today? The seeds are measured by your actions you're taking. the words you're saying, the thoughts you're having, and the emotions you're feeling. And then that will lead to habits and your character and your personality and your destiny. So take small and simple steps each and every day to improve. With some consistent effort, I guarantee you, you'll be a much happier person and well onto your way to being wealthy in a very holistic approach, not only financially, but on many other aspects of life. So that is it. Invest in Yourself Revisited by Sean Taggy. Thank you so much, guys. I appreciate you listening. I appreciate all of your support and love coming from the internet and everywhere else. So 2021 Sofa Summit, helping you on your way to becoming a cash flow king. See you guys. Well, guys, you might be seeing this Yeti hanging out right here. And so what we're doing is we're going to give away a few Yetis to some lucky individuals.
3 lucky individuals. And there's 3 different ways to win the Yeti. The first one is, you've already done it, is just register and attend the actual event. Then the second way to win the Yeti is to subscribe to our YouTube channel. And the third way to win a Yeti is to be interactive and have the best comment in the little chat bar.
Yep, so be commenting. Let us know your thoughts, comment, or question. We will consider on helping you win that Yeti. So thank you so much, guys, and we appreciate you being here.
All right. Welcome, everybody. Mark Hart here from MIP, and I am thrilled to introduce our next speaker for the 2021 SOFA Summit. Ryan and I have worked together very closely for many years, helping our clients scale their single-family rental portfolio businesses. And what I love about Ryan's program is that it just allows you to use the same amount of capital but have a higher cash flow, a higher net worth, and achieve financial independence faster, right? So it's something that I'm such a big fan of. I'm actually going through the process with him right now as we speak. And so it's definitely something that you guys should take a look at if that's one of your goals. So that's it. Ryan, I'll let you take it from there. And how are you doing today?
I'm doing great, Mark. And man, it's a pleasure to be on with you. I love your community. We've done a couple of these SOFA summits, and everyone I talk to from the MIP community is just amazing. And I got to give you some kudos as well, because you make my life a lot easier in 2 ways. Number one, we talk a lot about real estate, but doing real estate is a very, it's a difficult game, and you play in that game. And so you see it tip to tail, you see how that works, and you facilitate people getting the cash flow, owning the real estate without having to do really much of the work at all, other than just coming prepared with money available and ready to build a system at that point. But you make getting into the world of real estate so much easier. And you make my personal life easier. You've done so much business with my sister that she's like, dude, Ryan, if it wasn't for Mark, I don't know if I'd even really like you that much. So thank you. Thank you for all your help with that.
Always a pleasure. Always a pleasure. Keep it in the family.
Heck yeah, man. Well, dude, I'm excited to share this with you today. The title of what I'm going to be sharing is it's the and one strategy. And Mark, I'm going to share my screen during this, if that's okay. So you'll have to give me access to be able to, oh, maybe I do have access to that. Okay, there we are. Cool.
Perfect.
So our mission here at Cashflow Tactics is to really empower people to become financially free in 10 years or less. And I say it that way very intentionally, to become. Like, we don't wake up one day and you're just financially free. You have to literally become a new person with new skills, with new abilities, and with a new awareness of what money is and what it represents. And so, inside of our world, and I would imagine the same is inside of your world in MIP, the people that are willing to take on this mantra that we talk about of rising up, taking control, those are the people that can then graduate into truly living free. And the only thing that's holding most people back from what they say they want is themselves. They have to become someone new. So we're going to talk a little bit about that today, because my objective today is just to give you a new perspective around how to use money more effectively, how to get what you want faster with more control over the outcome. The mission of what we do in Cash Flow Tactics is, I believe anyone with the right set of principles can become financially free in 10 years or less. It doesn't matter where you start. I've seen people start with no money, myself included. I've seen people start with a lot of money or anywhere in between. So regardless of your age, your income, or your experience, the objective of Cash Flow Tactics is to teach you principles and then empower you to go out and tactically apply those principles to get a result. And the result is financial freedom. So I'm going to kind of go right to the punch. I'm going to skip right to it. And, we usually spend a lot more time building up to this. And, I think a lot of the people that are in your world already, Mark, they already have a different mindset of money. And sometimes I see people, they're trying to do a little bit of everything. They might still have a properly diversified portfolio and, money in Bitcoin and IRAs, and then they're just doing real estate on the side. I've seen other people that go into the game and they're all in. And so I'm going to talk, without giving you any context, that I'm going to tell you a truth that I've learned, a principle that I've learned. And, if we think of traditional financial advice, what we've all been basically trained, taught, and educated to do is we go to school, right? In some form or fashion, we go to school, we elevate our skills and our abilities. Then we go out and we get a job of some kind, right? Maybe you have a business that you run. Maybe you're an entrepreneur. Maybe you're an employee. Maybe you're an executive, whatever it is, but we have a job. And then we take that education and that job, and we take a portion of our savings and we put it somewhere. And I think universally, we could say we all have the same goal. Whether we want to call it retirement or we want to call it financial freedom, we all want someday our money to come back to us as a stream of income so we can own and control our time. Mm-hmm. But I believe, after having talked to literally thousands of people, that the traditional path of maxing out your 401k and, deferring your taxes and hoping with your fingers crossed that one day you're going to have enough money, it doesn't work. And the reason I say that is it's almost irrelevant how much money you end up having in your accounts. When you put money in those accounts that you don't control and you've deferred your taxation and it's subject to market fluctuations, I've seen people with, on paper, enough money to be able to retire, but scared to death to do it. Mm-hmm. I've seen people that have followed all of the rules, and despite their best efforts, they have nowhere near the amount of money that they need to be able to retire. So we just skip right to the chase and say, look, if you want to be financially free, if you want to be confident, and I would even say certain inside of what you're doing, traditional finance is one of three things. It's dangerous, it's misleading, or simply it's outright wrong. And the faster you accept this, and a lot of people have to go through the stages of grief, this denial, it's anger, it's all the things until you get to acceptance. And inside of our community, we'd spend a lot of time on helping people cross that bridge. But once you can cross the bridge, the 3%, it's not doing average things better. It's doing the exact opposite. And we can apply this truth in almost any area of life, right? We can look at in the business world, in the sports world, and see people that are extremely successful. And then we can see people that are good, right? They're decent. The people that are extremely successful and the people that are just average, the people that are successful, they're not just doing average things better. They're doing the exact opposite. They're outliers. And so our objective today is I'm going to show you what the 3% do. Does that work for you, Mark?
That sounds like a plan.
Cool. Well, let's dive into it then. The first thing that we have to break then is this idea of diversification. Like, this is kind of the holy grail. If you want to invest, you have to have a properly diversified portfolio. Okay. And I want to ask why. And the best reason that I've found out how to ask why is, like, remove the financial discussion from this idea of diversification. And let's just put life into this. Mark, I have a wife. And what if I approached my relationship with my wife with a sense of diversification? What if I said, you know what? Hey, Beth, just in case this doesn't work out, do you mind if I have a couple of, other potentials on the side?
Yeah, you wouldn't have a wife for very long.
I wouldn't have a wife for very long, right? What if I did that in my career? What if I said, you know what? I really want to be a surgeon, but I also want to be a lawyer. And in addition to a lawyer, I also want to be a baseball player. So I'm going to diversify my focus and my attention into those three areas.
That sounds like you're going to be bad.
How good am I going to be?
Yeah, bad at everything.
Bad at all.
Yeah, subpar.
So this is subpar, 100%. I'm going to go right back to the average game. And this is one of the biggest misconceptions inside of finance is diversification is the holy grail. And I want you to consider why. Okay. And we're going to break this down inside of what Mark does inside of MIP. But look, when you diversify, it really comes down to a lack of control. If I put my money in a place that I don't control, let's say I put my money in a properly diversified portfolio. Tomorrow, maybe President Biden gets up and he says something, crazy, and the market like takes off and it tanks, right? Maybe the next day, I don't know, Elon Musk says, hey, I figured it out. We're going to the moon or to Mars or wherever he's going these days. And then the market's like, awesome. Now everything's going to go up, right? I don't have any control over that. And so if I don't have any control, I have to diversify. I have to spread my money out. And hopefully if something goes down, something else, maybe not correlated to the thing that went down, will go up and kind of balance me out. But one of the greatest investors of all time, Warren Buffett, who, by the way, and I won't go into why, does not actually invest in the stock market, even though people think he does. He actually buys businesses, and that's his investment. But he says, look, the goal of a non-professional, and guys, this is where I started, right? If you want to be financially free, you have to rise up. You have to develop a certain set of skills to be able to become financially free. So if you're unwilling to do that, the goal of a non-professional should not be to pick winners. Neither he nor his helpers can do that, but should rather be to own a cross-section, diversification of businesses that in aggregate are bound to do well. So he says, if you're unwilling to rise up, then yeah, you should probably diversify and wait it out with your fingers crossed and hope that it works out. But what he says down here, and this was in the exact same article, he's like, you know what? Diversification is actually just protection against ignorance. So if you're willing to stay ignorant, you should diversify. If you're willing to invest a little bit, and guys, that's exactly what you're doing right now. You're watching this video, you're investing in your mindsets. Diversification is protection against ignorance. It makes very little sense to those who know what they're doing. Okay, so Mark, the goal of this conversation is going to be how to focus. And if you focus, would it be possible that you could be free in 10 years or less? I think yes. In fact, I've seen it happen over and over and over again. And so I'm not going to spend too much time on this, but we teach a formula, okay? And the formula is basically a system, right? If I do something once, but I don't know how I did it or how I got the result, then I can't really duplicate it. But if I can do something once and I know how I got the result, I can go back to the beginning and run the same process and get the same results. And so the goal of this is we got to engineer financial freedom. We've got to build a backwards approach to a system to say, for every dollar I put in, I know how to use it to get what I want. So the first thing that we want to break is this idea of retirement. The goal isn't to retire one day. The goal is to be financially free. And the way retirement wants you to measure your success is based on your net worth. Net worth is kind of cool. I like having a good net worth, but at the end of the day, like if I have $1 million in net worth, am I free? I don't know, right? I'm not really free until I understand how much my assets produce in cash flow. Once I understand how much my assets produce in cash flow and how long that cash flow will last and how it's likely to perform with inflation, then net worth will become relevant. So what I just say is, look, stop focusing on net worth, start focusing on the assets that produce cash flow. And this is right up your world, Mark. I mean, you deal with cash flowing assets every single day. And financial freedom is super easy. When your cash flow exceeds your expenses, well, you own and control your time. No longer do you have to trade your time to pay for your lifestyle. Your income, your cash flow pays for your lifestyle. Okay, and so that's the first target. And there's a lot more context we could set with that, but the target is cash flow greater than expenses. Now, we need a way to focus, okay? And I'm going to teach you two lenses today that will kind of set up this conversation that we're going to have. It's the core four and the four pillars. It's one thing to say diversification is protection against ignorance, but it's a whole different thing to know what to focus on. So the core four and the four pillars is meant to give you the tools necessary to be able to focus, okay? So the first thing is the core four. Now, Mark, I remember back in the day, I had a corporate job and, people would get around the water cooler. I don't know if people hang out at the water cooler anymore, but people would get around the water cooler and they talk about their weekends and what they did. But a lot of times they would talk about, hey, did you hear about this investment? Or, hey, guess what? Bitcoin wasn't around back in the day when I started, but there's this really hot thing. Have you tried this? Or have you heard about that? Back in the day, I got invested in this foreign currency called dinar. It's the Iraqi currency. And it was all around the water cooler. Someone said, hey, we're in the war in Iraq and it's going to be, when we go in and stabilize the economy, the dinar is going to go up. And people were talking about this. I'm like, oh, I want some dinar. But like the reality of this is it's really hard to focus if I don't know how to analyze what I'm investing. So in the core four, no matter what happens at the water cooler, no matter what your brother-in-law brings to you and says, hey, you should check this thing out, you get to ask yourself 4 questions, okay? And when you invest, you have to increase 2 things in your investment and you have to decrease two things in your investment. Okay. The first thing that you have to increase is your level of control. Okay. It goes back up to what Warren Buffett said. If you're not in control, you have to diversify. But if you are in control, you can start to impact the outcome. Like if I put my money in a 401k, I don't have any control over that, which means even if I say I want to retire sooner, I can't predict it and I can't control it, which means I'm just along for the ride. So
right, exactly. If someone sends a tweet and all of a sudden your 401k goes down, that's the polar opposite
that
of
kind of
control.
sucks.
Just a tweet.
Yeah, that's the exact opposite. Those dang tweets, man. I lose money on tweets. I hate that.
Yeah.
But yeah, you got to increase your control. Okay. And the next thing is, I mean, we can all probably assume we've got to earn a higher return, right? Our money has to work harder if we want to be financially free in 10 years or less. But Mark, I'll never forget when I sat down and I started exploring the world of alternative investing, the number one thing that I heard over and over and over again is, what is your risk tolerance?
Mm-hmm.
And I thought that was the ticket to play. I thought you had to be willing to lose money if you wanted to get a higher return. But I've now learned the opposite. All things being equal, I don't want to lose money. I mean, I don't want to lose money to get a better return. And so the opposite of this is you have to be able to increase your return and actually systematically decrease your risk. And that sounds like an oxymoron for most people, but I'll share with you how you do that. And last but not least, and this is what blows my mind about how traditional finance is done, the biggest destroyer of wealth, we all know what it is. It's tax, right? That's the biggest destroyer of wealth. But yet what we're trained, taught, and educated to do in personal finance is put our money in an IRA and take that IRA money and ultimately the tax liability and shift it to the future. You don't pay taxes today. You're going to pay taxes in the future on everything you put in plus everything that you've earned. And you're told that you're going to retire in a lower tax bracket. Now, I have news for anyone listening to this. There is no such thing as a retirement tax bracket. The only way you retire in a lower tax bracket is if you retire poorer than you are today. And that's not most people's version in their mind of what they want their retirement to look like. So we don't want to shift our tax to the future. We want to eliminate it. Okay. So we want to decrease our tax. So when your brother-in-law comes to you and says, hey, I've got this, this hot, investment, this hot stock tip for 2021, ask yourself 4 questions. How much control do I have? What's my return? What's my risk? And how much tax am I paying? And for most people, they play the game the exact opposite. They have low control. They get a low return. They take a lot of risk to get it, and they pay taxes or shift their taxes to the future. Okay, so that's the first element to allow us to focus. Now, the next one is this one right here. How on earth do I increase my return and decrease my risk? Okay. And this is where the 4 pillars come in. Okay. The next one is the 4 pillars. And this is why I love what MIP does, what you guys do, Mark. I'm going to put just 2 investments out. Now, I think the average person that plays the game of finance has money in stock. I talk to a lot of people inside of our world, and that's usually where most of their money is. And that's usually the reason that they're stuck. Mm-hmm. Right. But let's put up an asset like real estate. In every investment, in every single investment, there is a potential to make money in 4 ways. Now, most people, when they hear that, they're like, what are you talking about? I don't make money in 4 ways. But in every investment, there's a potential to do it. It just depends on how you're participating in the investment. So if we play the game of the 97%, how average people do it, you got your money in the stock market. And Mark, how does someone make money in the stock market?
Just appreciation, maybe a little bit of cash flow through dividends.
Maybe a little bit of dividends, right? Yeah. But in most cases, it's appreciation. I buy a stock or a mutual fund at one price. I wait, I sit, I hope. And maybe at some point in the future, I can sell it at a higher price.
Exactly.
Now, back when I got into the world of real estate, it's really interesting. My business partner and I, we got into real estate about 18 months apart. He got into real estate in 2007. I got into real estate in 2009. So it was only 18 months that separated the two of us. But everyone buying real estate in 2006, 2007, and 2008, they were buying primarily for this. Hey, I can buy a property and I'm going to sell it tomorrow. I'm going to flip it tomorrow for $50,000 more. Right. And the reality of this is, if this is the only way we're making money, we don't control the outcome.
And it's risky.
It's risky, super risky, right? It's, hey, a tweet goes out and now the real estate market crashes, right? And the people that bought real estate using leverage to buy real estate, hoping that they'd make money on appreciation alone, they lost. Those are the people that lost big time in the world of real estate back in 2008. But Is it possible, Mark? And I don't know if you've ever seen this before inside of your world, but is it possible for someone to own a piece of real estate that goes up in value, and independent of how much it's valued, they also get a check in the mail every single month in the form of cash flow?
Every single day.
That's
We've been
every
doing
single
it
day.
since
Isn't it?
1979.
Thousands of times through years of experience seeing this. And the crazy part is my cash flow is not tied to my appreciation. If the property goes up in value, that doesn't decrease how much cash flow I can take. I still get the same amount of cash flow. And the next thing is, I want you to think about it this way. The IRS, they use the tax code as a way to incentivize behavior. It's kind of like that carrot dangling at the end of the rod there. And they want people to do certain things. And if you do those things, they use the tax code to incentivize that. They want people to own real estate. And when you own real estate, you get several tax benefits. Okay, you get to depreciate, you get to treat it like a business. I mean, you get so many tax benefits that makes, in most cases, your cash flow 100% tax-free. Last but not least, I get to use leverage. It's the most powerful tool in finance. It's also the most dangerous, so it has to be used judiciously. It has to be used intentionally. It has to be used responsibly. But let's say this property is valued at $100,000. Now, if I'm going to buy a stock, like if I want to go to Elon Musk's world and buy a stock that's valued at $100,000, I have to have $100,000 to do it, right? But if I want to go to the world of Mark and I want to buy one of your properties out in Memphis and it's valued at $100,000, do I have to bring $100,000 to the table?
You're putting 20% down plus closing costs.
Boom.
Whoa.
I get to bring a fraction of the money, but yet I get to control the entire asset.
Mm-hmm.
Okay, now this is how it decreases your risk, right? Because now I'm earning a return in 4 separate ways here. But Mark, does real estate, does it always go up in value?
Not every single year, not in 2008.
Yeah, what if the real estate goes down? Well, that's too bad. I'll just sit back and I'll collect my rent checks. I'll wait for the real estate to come back. I'll collect my tax deductions. And I only had a fraction of the money in to begin with. So I'm still making a return in 3 separate ways. Or what happens if my tenant skips town and my cash flow dries up for a month or 2? That's part of the game in real estate. But you see, I'm still positive in 3 ways. This is how you start to earn a higher return, but actually take less risk in doing it. In fact, inside of the world of single family homes and turnkey investing, the way you win is by staying in the game. That's it. Like if you get out of the game, you lose. If you stay in the game, over time, you win. And so this having 4 pillars is how you stay in the game. So Mark, this is now how we focus, right? Our core 4 focuses us. Our 4 pillars helps us go faster. The last piece of this is velocity. And I'm going to talk about that at the very end. But when I first learned this idea of the 4 pillars, my question was, awesome. I want to invest in all of the assets that have all 4 pillars. Just show me everything. I want to know, right? And the crazy part about it, there's only 3. There's only 3 assets that have all 4 pillars. Now, number 1, we just talked about real estate. Number 2, own a business. Think about a business. You get appreciation, you get cash flow, you get tax deductions, and you get lots of different kinds of leverage, financial leverage, systems leverage, people leverage, lots of different things. But the third one is what is called a vault. Now, this is the world that I specialize in, and it's a uniquely designed investment grade life insurance policy. And I remember when I first heard about this, I'm like, whoa, what is this, right? What is this? But here's what it does. And then I'll show you why I say it's hiding in plain sight, and I'll show you why in just a minute, okay? When these policies are built the way I'm going to share with you today, you get the opportunity to put your money into a policy. And I want you to think about it kind of like your bank with a personal line of credit, okay? So you get to put as much money into it as you want. Let's say you want to put $10,000 a year or $100,000 or, $500,000 today and then $50,000 a year thereafter. You get to put as much money as you want into it. It's one of only 3 investments that eliminate tax. So if it's done right, all of the money that you put in, plus all of the growth that you're going to experience inside of this is all tax-free. Okay. It's a private contract between you, a private individual, Mark, and a private insurance company. So it's safe, private, and protected. The insurance company on the cash that you're putting in will give you a guaranteed growth rate for as long as you live. Like it's literally locked into a contract that they'll put a guaranteed rate. Today it's 4% for as long as you live. Now that's pretty crazy. On top of that, you get an annual dividend. You share in the profitability of the insurance company. So we use what are called mutual insurance companies, and you can't buy stock in them. But when they make a profit, they share it with you. And the companies we work with, in fact, Mark, the company you're looking at, they've paid a dividend for 173 years straight. Never missed a year. So now that's
Wow.
pretty cool, isn't it?
Yeah, that's wild.
It's IRS sanctioned. Okay. And I'm going to share this with you in just a minute, but it's IRS sanctioned. It's 100% tax free. So all of the growth that you're getting is tax free. Your cash is liquid and can be leveraged. Okay. So let's say I've got $100,000 of cash value inside of this account. It's now earning a guaranteed return of 4% plus a dividend. But I can also leverage it. And I want you to think about it kind of like a line of credit. Okay. That $100,000, the insurance company will say, hey, you can use that money for whatever you want. And the insurance company is actually going to issue the line of credit to you. They're not going to take your money out of the policy. So your money is going to still compound. And what they do is they use the death benefit as collateral. Just like with a piece of real estate, I can go to a bank and say, I've got $100,000 of equity. The bank will give me a line of credit. I still get to own the house and have all the benefits that the house offers, but I get to use the line of credit for something else. Same thing with your policy, but now your money's doing multiple jobs at the same time. Okay. Now you're 100% in control of it. There's no red tape whatsoever. You can use it however and whenever you want. Remember, it's a private contract. And whenever you're ready to use it, you can take the money that you put in plus the growth that you've experienced. You can take it back out as a source of tax-free income. Okay, so it's a pretty amazing account when you think about it. And when I first heard about it, I was getting my master's degree in finance at the time. And I was like, dude, let's see if I can get my little thing to play here. Is it going to play for me? Oh, there it is. Yeah, there he goes. I was like, no, there's no way.
Nope.
I mean, that's a lie. I've never heard about this ever. No possible way. But as I started to dig a little bit deeper, here's the crazy part. Okay, billionaires today, and these are just two of them. Billionaires today, like Warren Buffett and Bill Gates, they have over $1.5 billion inside of these accounts. Why? Well, of all the benefits I just shared with you up above. Banks, like we think banks are that's the safe place to keep money. What do banks do? Banks have to have what's called tier 1 capital. So this is reserves that they have to have outside of their just the normal banking institution. Today, over 217 major US banks keep $143 billion inside of these contracts. They don't even keep their reserves inside of banks. They keep it inside of these type of contracts.
Right. That's where they take our money and they put it in the vault.
Isn't it crazy, right? Here's the other crazy part. I said it's hiding in plain sight. Today, politicians, over 54 elected politicians that we know about, have secured millions of dollars inside of vaults. And in fact, every 4 years when a president runs for president, they have to disclose their income and their money. So President Biden, when he ran for president, we got to find out everything he did. Guess what? He has 7 of these high cash value vaults, all with a company, MassMutual. So this is where these guys are keeping their money, but yet they're telling us to, hey, go have a property diversified portfolio. Okay, so what would this world look like? What would this world look like if I could have my money working in multiple ways? Remember, the last part of that equation was velocity, okay? So what if I put money that was going to go to real estate? What if I put it in a vault? I got all the benefits that I just explained to you in a vault, but then I leveraged the value, the line of credit of the vault, to buy an MIP property, right? The cash flow that MIP property is going to produce, I'll use it to pay my line of credit back. And what if I just repeated that process over and over and over again? So I'm calling this the and one case study, because in the game of basketball, if you have the ball and you drive down the lane and you shoot, if you get fouled in the act of shooting and you make the bucket, you get to go to the free throw line and add on an extra point. It's exactly what this is, right? If you're going to buy real estate, which is absolutely 100% what you should be doing, what if you could add on the vault in front of it and get more bang for your buck, get an and one asset, okay? So let's go through this. I'm going to give you just some numbers here, and then we're going to do some math. We're just going to do a case study. And I know there's a lot of different components with real estate, like, rents go up over time, the value goes up over time. And I know there's all of that. So I'm going to try to make this as simple as possible, knowing that we can make it more complex if we wanted to. But all I'm going to say is, what if we put $1 into real estate? And we're going to look at that. We didn't use the vault. We just bought real estate. Then I'm going to say, what if we put the same dollar into a vault first and then bought the same real estate? So exact same thing. The only difference is buying the vault. Okay. And here's the example I'm going to use. Whoops. We're going to buy the property for $100,000 in cash. Okay. We're going to assume that it's going to have a 3% annual increase in value. So every year it's going to go up by 3% just based on perception of real estate. We're going to assume that we get rent of $1,000 a month. Okay. And I'm just going to keep it level, $1,000 a month for the whole time we own it. And we're going to look at this over 30 years. Now, maybe you buy it for 20, but I believe once you buy property, you should hold it. The longer you hold it, the wealthier you become. So we're just going to look at it over 30 years. Okay. So here's how we're going to do this. Okay. We're going to start over here and we're going to do some math. Okay. You with me on it, kind of setting this up? All right.
Let's do it. I love it. Very
All right,
conservative. No rent growth for 30 years. Wild.
That'll just make the math easier to do. Okay. So we've bought a property for $100,000. The first thing that we're going to look at is our appreciation. Okay. So we're going to look at our appreciation. We bought it for $100,000. We said it's going to go up at 3% a year, and we're going to hold the property for 30 years. So just by having the real estate, we're going to put $242,726,000 in our pocket. Okay. Awesome. Just by owning it.
Mhm.
Now, over this time, and again, it'll hopefully balance out a little bit because we're not going to include rent increases, but let's say that we can cash flow this thing $1,000 a month. And let's just assume there's no vacancy. Okay. So $1,000 a month, times 360 months, right? 30 years, that equals $360,000 of cash flow. Okay. So these are the two things. Now, the cool thing about this, all of that's tax-free cash flow, right? Because I get to offset it with depreciation in the real estate. And there's lots of tax advantages in this. We won't go into that today. But if we back out the $100,000 that we bought it for, now we get to determine, well, what's our wealth position? Okay. So the wealth position, if we took the $360,000 plus the $242,726 that the property is now worth, $602,000. We back out the $100,000 that we bought the property for, we're at $502,000, right? And over this time, we've collected $360,000 of cash flow. Okay, so that's buying the property. Now, man, if we hang out with guys like Mark and MIP, man, what if we did that 30 times? Like, what would our world look like if we just repeated that over and over and over again? That's a pretty awesome world to live in, right? But what if we added the vault to it? Okay. Now this is where things are going to get a little bit interesting. So we'll spend a little bit more time on the math over here. But if we buy the piece of real estate, all we're doing now is we're taking the money, the $100,000 that we would have bought the real estate, and we're dumping it into a vault first, a high cash value life insurance policy. Now, there is some cost with the policy that would adjust things slightly, but in the grand scheme of things, it doesn't make that much of a difference. So I'm not going to factor that in on this calculation. Okay. Now, Mark, you've seen policies. If these policies are structured right, the cost is minimal and it's only experienced in the first couple of years of the policy. Okay. So the appreciation on the property will be the exact same. I'm going to own the same piece of real estate, whether I buy it with a vault or without a vault. So my appreciation is still going to be, where did my calculator go? $242,726. Now my cash flow is going to be a little bit different. Okay. And this is where, remember, I've put the money in a policy and I'm taking a policy loan. Okay. So the insurance company is issuing me a line of credit and I'm taking a loan from the insurance company to go buy the real estate, which means I have to pay that loan back and there is an interest cost associated with it. Now, there's a little bit more detail we can go into this, but other than that, what I'm going to do is I'm just going to kind of show you what that would look like. Okay. So I'm going to get a payment calculator out here. And we're going to say, okay, if I took a $100,000 policy loan, and let's say I'm going to pay that off with my monthly cash flow every single month, I'm being charged a 5% interest rate, which is about what the interest rates are on these policy loans today. And I'm going to pay it off every single month that I collect cash flow over 360 months. What that's telling me is my payment to the insurance company would be $534. So we'll just round it up to 535. And so if we look at that, what we'll say here is the $1,000 a month that I was collecting in real estate in cash flow, I now have to back out the money that's going to go to the insurance company, $535. So my net cash flow is $465 a month. Okay.
Nice.
If I times that by the same 360 months, I'm going to collect 167,000. So 167,400 in cash flow. I bought it for $100,000. So I'm going to back that back out. And here's the real estate total. Okay. So let's look at this. 242,726 plus 167,400. Okay. I'm at 410 minus the $100,000 that I bought it for. I'm at 310,126. Okay. If we just stopped the analysis there, we can say, well, over here, I was at 500,000 And over here, because I use the insurance policy, now I'm only at 310. So if I looked at just that, why would I use an insurance policy? It doesn't make any sense. Okay. Now what's happening in the insurance policy is all the time that my money has been deployed in that real estate and I'm paying back a loan. Remember, my money is doing two things. The insurance company gave me the loan, so I'm paying them back, but my $100,000 was in a policy compounding and growing the entire time. Okay. So here's the crazy part. If we take, and let's actually use a different calculator. Is the logic making sense here so far?
Perfect sense. That's why I'm getting a policy.
Yeah, buddy. All right. So let's get a future value calculator out here. Let's clear it out. So we've got $100,000 that we put into a vault. These vaults today are earning about 5%. Now, the longer you have them, the better they get. So it'll actually be better than what I'm sharing with you here. And I put an illustration in here so we can look at it, but we won't spend too much time on it. So I've got $100,000 and I'm earning 5% over the 30-year period of time. So why I've got that real estate, I bought the real estate, but that $100,000 in the vault over that same 30-year period of time grew to $432,194. Okay, so $432,194. Now, the other cool thing is, today we live, and this is good for real estate investors, right? Today we live in a really low interest rate world. So we can borrow at a really, really cheap, low rate, but it's kind of crappy when you're looking for a place for your money to live. So every month that I'm collecting this cash flow, unless I'm spending it, what am I doing with it, right? What if I had a place to put it where it was still liquid, where it was protected, where it eliminated taxes and it grew? Okay, so if we look at this, my payment on the real estate over here, let's get this up. The payment on the policy loan was $167,400 divided by 360. It was $465, or excuse me, it was $500. So my net amount of cash flow that would be left over is $465. Every single month after I paid the policy loan, I'd have $465 that has to live somewhere. What if I put it in a policy, right? So if I put it in a policy, I times that by the same 360, that adds another 167,000. See, did I do that right? So let me see if I did that math right. 100,000. Okay, that's right. Annual payment 5,500. Okay, that's right. Okay, sorry. Let's back this out here. So let's pull up the other calculator. All right, there we go. Payment calculator. This is what I needed. Okay, so over this period of time, my monthly payment is $534.59 to the insurance company, which means I would have an excess amount. Now, maybe I was right. $1,000 minus $534.59, $465. Okay, so $465 every single year. Now, if I put that into a vault for 30 years, that's 360 months. I would have $167,000 of additional cash. Okay, so 167,000 of additional cash. So just by using the vault, these two things here, right now, if we add those up, 432,000, opening up a lot of calculators. I wish they'd stay open. 432,194 plus 167. I have an additional $600,000, right? $600,000 in cash value just by using a vault. So I have $600,000 in cash value and I have the real estate. But here's the crazy part. Okay, with this $600,000 in cash value, if I'm earning an interest rate on this money, which I am, right? That's $600,000 at 5%, which is what these insurance contracts are doing. That's what I did wrong. All right, there. I was wondering where my math went wrong. Okay, future value. So what I'm going to do is I'm going to put in this. So the $100,000. Sorry, man. 167 divided by 360. So I have $464 a month times 12, 5,566. So every single month or every single year, I'm able to put in an additional $5,500 of cash flow into my vault. Okay. And if that grows at 5% every single year, my total net outcome at the end of this is 820,000. Okay. 820,000. So I was wondering where my extra money was going. 820,000. Okay, now that's at 5%, $820,000 times 5%, that's an additional $41,000 just of interest only income. So at the end of 30 years, right, I've got now $41,000 per year of interest income that I can take off of that. In addition to, right, in addition to the $12,000 that I have over here, $1,000 times 12, right? I still own the same real estate. So my total cash flow down here is $53,000. Cash flow from the real estate and cash flow from the vault. Now, one thing here, and it's always different for every single person, but the goal of all of this is to decrease and get the least amount of death benefit as possible in these policies, because that lowers your cost. But at the end of the day, you still have life insurance. Okay, so what if I also had, $2 million of insurance? Okay, so with all of this combined, not only is my cash flow, $53,000 a year of cash flow versus $12,000 a year of cash flow, but in addition, my combined wealth position, $820,000 plus the $310,000 up here, that's 1.1 million, 1.1 million, because I bought the real estate with a vault. So that's the game here, right? If we can get that and one, if we can have our vault and have our cake and eat it too, and own the real estate, why would we not do it? So the game here is this idea of the 4 pillars. If I could take my money and put it in a vault where I get appreciation, where I get cash flow, where I get tax advantages, and I get to use leverage, I could use that leverage, right? Pull it back out, go buy the real estate that I was going to buy anyway. This isn't buy a vault and not real estate. This is buy a vault and buy real estate, right? And in the real estate, I get to use leverage, I get tax advantages, I get more cash flow, and I get appreciation. I take the cash flow and I use it to pay back my vault. And the goal of this is I want to do it as fast as I can. I want to repeat this process over and over and over again. And, for me, as I first got this going, I was saving about $1,000 a month back in the day when I very first started this. And that $1,000 a month for me, it required my time. I had to show up to work. I had to earn a salary. I had to not spend all of my money and pull some of it out for a future goal. And it required me. And if I didn't show up to work, if I didn't get paid anymore, everything stopped. But the crazy part was when I built a vault and I bought this first property, right? I had about $350 a month on the very first property that I bought. And I'll never forget that because, man, I was saving $1,000 a month, but my real estate was now adding an additional $350. My savings rate went up by 35%, not by any more effort that I put in, just by buying the right assets. And when I did it the next time, right, my savings percent went up by 70%. And by the third time, I had doubled my savings rate. And here's the crazy part. Every time I was paying back my vault, with 3 properties, I was able to pay it back 3 times as fast. With 2 properties, I was able to pay it back twice as fast. And so this snowball started rolling and I was able to gain more and more momentum, more and more velocity built in. And this is the path to achieving financial freedom in 10 years or less. And the last thing, before I share anything else, Mark, does that make sense? Any questions or thoughts on that?
Makes perfect sense to me. And you got a lot more content on your website in case that didn't make sense to any of you guys out there.
We do have a lot more content. And the vault, it can be kind of, because it's so new, most people are like, whoa, I don't get it. I need to see it a few times. It took me like 18 months to fully understand what the heck this thing did and how it works. But man, once I understood it, it was so crazy powerful. But here's the part, here's what I tell people. There's really just 3 steps. If you want to be financially free, there's 3 things you need to do. You need to get really good at making money. Right? Because this is your best asset, right? Go out and create value. You already have talents and abilities and skills in whatever you do today. Go maximize those and go create as much value as you can and make a bunch of money. But I've talked to a lot of people, Mark, and you've probably talked to these people as well, that they get really good at making money, but they're kind of crappy at the next part. And it doesn't matter how much they make, they have nothing to show for it. These are the athletes that make millions of dollars and 2 years out of the league, they're broke as a joke, right? And so the next thing to truly be free, to truly build a sense of abundance in your life, you've got to keep the money that you're making, right? This is where the vault comes in. Every single year, you get to raise the watermark. Every year that I put money into a contract, it's locked in, it's part of a contract, it's private, it's growing, backed by a company who's done it for hundreds of years. Then the last part of this is I have to learn how to cash flow my money. It doesn't really matter what my net worth is until I understand how much income my assets produce. And hands down, the best producer of cash flow is real estate, hands down. So go make money, go keep money, and go buy turnkey real estate. And then just repeat the process. Go make some more money, go keep some more money, and go build some more cash flow and repeat this process until freedom until you own and control your time. That's the mission of Cash Flow Tactics. That's what it means to truly rise up and live free. And the vault is just meant to raise, it's really meant to raise the standard. It's meant to tilt the odds in your favor. And it's meant to play the game that other people are playing. You just don't know about it. Like all these people, they're playing the same game. This is why they're wealthy and why most people aren't. They're not doing average things better. They're doing the exact opposite. So Mark, that's what I got for your community today. Man, I hope it was powerful. I hope it was impactful. But guys, that's the path of becoming financially free in 10 years or less.
I love it. So Ryan, how many properties do you have right now? How many policies do you have? Tell me more about yourself.
I love that, man. So I started this game almost 11 years ago now. And, you know, I did everything traditional. I mean, I grew up in a great family and I was taught to work hard from a young age. And, you know, for me, social conditioning kicked in. When it was time to grow up and put my big boy pants on, I went to school, I got a job, I put my money in a 401k. And I remember when I got in the corporate world, like I was really disenfranchised. In fact, I was always entrepreneurial. In fact, I paid for my school with entrepreneurial side hustles during college. And I'll never forget when I got my first paycheck after graduating school, it was less money than I made as a side hustler on a weekend in an entrepreneurial venture that I had. I remember thinking to myself, I should just quit now. But I decided, again, the social conditioning kicked in. No, I can't quit. That's reckless, right? I'm just going to climb the corporate ladder. And for the next 5 years, I climbed and climbed and climbed as fast and as hard as I could. I got promotion. And with every promotion I got, I saved more money. But what I didn't really realize until after the fact was during that 5 years, I started making trade-offs, right? With every promotion came more responsibility, more pressure, more geography to cover. And I found myself being disconnected and actually losing everything I cared about: my health, my connection with my family. There was times in my life where I didn't even live in the same state as my family because of my work life. And I found myself thinking, this is just what you have to do. But in 2008, when I lost almost 80% of what I had saved in my 401k, I came to a really big realization. I thought I had done something wrong. Like I thought it was just me. I was an idiot. I did something wrong. But I'll never forget, as I started talking to my coworkers, there were people in my world that had been playing the game for 20, 30 years. And there were a few of them that I was looking up to, and I was literally modeling my path after their path. And I realized when I would talk to them, I realized they didn't control what they were doing, and their entire illusion of retirement just disappeared right in front of them. And I thought, man, I'm doing the same thing they're doing, but I thought I was going to get a different outcome. I've got to pivot. I've got to adjust. And it took me some time to figure out what that was. But over the last decade, I've been doing high cash value insurance policies and turnkey real estate. And I've done it now 32 times. I have 32 cash flowing assets. I'm closing on 3 more here in the next couple months.
Oh, yeah.
So 32.
Yeah.
And I have 8 policies. So over the years, as my cash flow has grown, my ability to save has grown. And so I have 8 policies, 32 properties, soon to be 35. And I just keep running the process.
Right. And that's the big one as well, which you don't need to buy the biggest policy day one. You start small and then you just stack them and you just get more and more policies. So just do what you can save, what you can keep, right? Today, keyword there. And then as you're able to make more money, well, then you can get another policy and create another vault as well.
Mark, and that's such a powerful concept. There's a lot of people out there that want to sell life insurance. And yes, I get it. I'm selling you life insurance. My mission is to make you free, period. That's my mission. My mission is to make you free, which means I shouldn't take all of your money and put it in a policy. I shouldn't take all of your money and buy the biggest policy I could possibly buy, because that just increases cost.
Right.
And it's exactly what Mark said. We look at where you're at today and what you can do today. And we take that number and we say, okay, for a male Mark's age, saving the amount of money that he wants to and can save, what's the least amount of insurance he has to have right now to maximize the cash value on the money he's putting in? And as he goes out and implements his game plan, builds up more cash flow, yeah, he might have the ability to have more or bigger vaults. But man, we just want to work with the facts and the details of what we can today so you can get back out to doing what you should be doing, which is buying real estate.
Exactly. So let's say all that math that you did before is confusing, because it took me a dozen times to go over that as well to completely understand. Where do the viewers right now get more information about the vault?
Yeah, man, that's a great question. So inside of Cash Flow Tactics, that's really what we do. I mean, we just do vaults and turnkey real estate. And this is why I love partnering up with Mark, because man, we talk a lot about it. We don't actually do the real estate. So we talk about how to do everything. We help you set up a game plan, and then we refer out to our people like Mark that do the real estate. So If you want to learn more about what we do and how we do it and how you can be financially free in 10 years or less, go to cashflowtactics.com/challenge. There's a 5-day challenge where over a course of 5 days, we'll walk you through the math of why 97% is dangerous, misleading, or wrong. We'll actually share with you what I didn't cover today, a strike number. Mark, it's so crazy powerful. If you eliminate taxes, what you have to be free is almost half of what you have to have if you're deferring your taxes. So we help you build a strike number to say, look, what if you weren't paying taxes on your cash flow or on your cash value from your life insurance? Like, your version of financial freedom is a lot closer than you think. And then the third day, we walk you through all the details of the core 4 and the 4 pillars. And then we give you a scorecard so you can go score your own assets. Like, that's the thing that's holding most people back, is their money's in the wrong place. And then on the 4th day, we show you how to build a game plan. And a game plan is saying, look, your best resource that you have right now for all of us is your attention. And, for most of us, we have so little attention. I mean, they say today the average human can only focus for 3 seconds. And that's pretty hard. If you want to be financially free in 10 years or less, you're going to have to learn how to exercise your attention for longer than 3 seconds.
Sure.
But what we do is we build a game plan and we say, look, of all the things you could do, what's the first thing that you should do? And we break everything down into what we call a target. Just do one target at a time. Focus your efforts and energy on one thing at a time. That's how you go fast.
I love it. I love it, man. So hopefully you guys found a lot of value in that session. Like Ryan said, if you need his contact information, please reach out, and on to the next. Thanks, guys.
Yeah, Mark. Awesome. Thank you, man.
Hey guys, Mark Hart here from MIP. Welcome to the next session for the 2021 SOFA Summit. This session is called the Property Deep Dive and Neighborhood Tour. First, we're going to start off, and I'm going to take a deep dive into one specific property. We're going to go over the Google Drive folder, and in this folder, this is the marketing material that you'll be able to view on your own for every single one of our available rental properties. So this is the information that you'll use to make an educated decision to see if you'd like to move forward with the home or not. So I just kind of want to walk you through it from our perspective, just so you can understand it a little bit better. And then once that's completed, we're actually going to go visit Sean, who's actually at the property. He's going to give you a little walkthrough of what the home looks like before renovation, so when we actually bought it. And then you can see the finished product as well. It's great to see that transformation. And then finally, best of all, we want to bring Memphis to you. So we're going to drive around the car a little bit so you can actually see the tour of the neighborhood. So you get to know the difference between an A, B, or C class neighborhood here in Memphis, Tennessee. Let's dive in. All right, hope you guys can all see that now. So first things first, always like to pull up the property on Google Maps so I can actually figure out where the home is going to be located. This property here is 2718 Marlene Street, located in 38118 or Parkway Village or Hickory Hill to the southeast side of Memphis here. Some things of note from a location standpoint is that some of the reasons why we really like this property is because of its proximity to the airport, which is due to the south of the city, because that airport is the busiest air cargo hub airport in the entire Western Hemisphere and the second busiest air cargo hub airport in the entire world. And all that means is jobs, jobs, jobs. About a third of all jobs in Memphis, Tennessee are located right there by the airport. So the fact that our property feels like almost walking distance to the airport there is one of the reasons why the tenants want to live in this specific neighborhood. Another reason why we really like this location is to the east of this specific neighborhood is Germantown. And Germantown is the highest income per capita in the entire state of Tennessee. So what that just means is a lot more of the white collar jobs to the east and blue collar jobs to the west by the airport. And that's one of the main drivers and one of the main reasons why a tenant would actually want to live here. All right. Next up, what we're going to do is open up the Google Drive for the property. Every single one of our available turnkey rentals will have access to one of these Google Drives. So it's great for you to have a little bit better of an understanding of what all these documents actually mean. At the very top here, you're going to see some folders. And in these folders, this is where we put all the pictures. When you're actually looking at one of our available homes, you're just most likely going to see the pre-renovation photos, which will be down here. That's because when you actually are able to reserve one of the homes, it's going to still be under renovation, but you're not actually going to close on the home until the rehab's 100% completed. So what we'll do is we'll show you the pre-renovation photos. We'll send some progress photos so you can kind of follow along. It's always fun. And then once the renovations are done, then we'll finish it off with a professional set of photos that you get to keep. Really fun to see the before, during, and after. Then what I really like to do is take a deep look into the pro forma here. All right, hope you guys can all see this. First things first is the photo. You'll see that the property looks awful. And that's why we put the under construction banner there. We want to let you know that that's not the finished product, right? This is what the property looks like when we originally bought it. Then over here to the right, you'll have the price. This price here of $84,900, it includes the renovation. It's one of the main frequently asked questions that we get. So this price here means the house is going to be finished with renovation, and all you'll have to pay on top of that is closing costs. This property here is a 2-bedroom, 1-bath, 1,100 square feet, built in the 50s with a driveway for parking. So the D stands for driveway under parking. Sometimes we'll do C, that means carport, and G is garage. It's a little lingo we have. Then the neighborhood score, C+. What that means is for the way we rank our neighborhoods, A, B, and C, an A-class neighborhood is going to be 90% or more homeowners or better. It's only 10% or less renters, right? That's the type of neighborhood where you'll have really good public schools. It'll probably look and feel like the neighborhood that you live at now. Then the opposite of that is like a C-class property, which is like where this home is located. And that's going to be all rentals. Now, there are D-class neighborhoods in Memphis, Tennessee. We just stay away from those properties because in those areas, because it's a little bit too difficult to get consistent cash flow and have the tenants do what you want them to do, which at the end of the day is really just pay rent on time and take care of the property. Then a B-class neighborhood is going to be right around the average for Memphis, Tennessee, which is about 50% homeowners and 50% renters here. So these C-class homes, these are geared a little bit more towards investors that are looking to maximize their cash flow and passive income. While the A-class homes, those normally have a little bit less cash flow, but they're considered a little less risky, and they normally appreciate a little bit more, thus giving you a higher total return, just not in the form of cash flow. So diving into the pro forma here, you'll see the property income, the target rent of $750. That's a target because at this point in time, when you're actually analyzing a property, if you're actually looking at reserving one, it's still under renovation, which means at this time, 9 times out of 10, we haven't found a renter yet. What's really great about our property management company, Reedy, and our in-house leasing team is that they're amazing. And they actually have been able to market the leasing and the available property so well that we actually have a waiting list of about 50 tenants that are approved, have cash in hand, and they're just waiting for a property to rent. So we're really fortunate that we've been able to rent all of our properties this year by the time the renovations are done, which means that you get cash flow from day one, or you already have a tenant lined up, they're approved, they've paid, they're just physically moving in, which is really great to see. Next, you have the vacancy losses. We put a 4% vacancy rate on the pro forma, which is conservative because as of now, our vacancy rate for the management company is a little bit over 1%. It's always good to be conservative on these projections and pro formas. Then you have the operating income of $720. Next, you'll see the management fees, which is going to be 8% of gross collected rent. So that means 8% of what's actually collected, which is the 720 of the operating income, right? You don't take 8% of 750 because you don't collect 100% of the rent 100% of the time. Then property taxes, $60 per month. One of the big ones with property taxes in Memphis, Tennessee, is that they get reassessed every 4 years. This is big because in a lot of other markets, they're going to get reassessed every time the property sells and trades, which means that as soon as you buy the property, your taxes will jump up. For us here in Memphis, Tennessee, they just got reassessed this year in 2021, which means you're pretty much locked in. They will vary slightly, as they change the millage rates, but you shouldn't expect to see a major change in taxes for about another 3.5 years, which is really exciting. Next, you'll have insurance, $37 per month. This is going to be a direct quote from our insurance company that we use on our personal rentals here in town. It's through Lipscomb and Pitts. They're one of the major players here in the Southeast. They actually don't even do individual residential policies, but we were able to get a master policy because we have so many properties. And we said, hey, if we bring all of our properties and allow our owners on the management side to use the insurance company for homeowners insurance, can we get a discount and can we get more coverage? And that's exactly what happened. This property here has about $3 million in aggregate liability coverage, and the premiums are going to be less than if you just went and got a standalone individual policy. Just another way we can use economy of scale and help reduce your expenses. Next is going to be repairs. So this pro forma is just a projection, right? This is not an actual. And what that means is that we estimate that the repairs on this property are going to be about $45 per month there, which is about 6% of the rent. And what that means is that you're actually going to get that money. That $45 will go to you. We just want to let you know that that's not all pure profit, right? Some investors don't know that they have to hold back money for reserves, for vacancy and repairs. And that's why we put it in this pro forma here. So you're going to get the vacancy loss funds, the repair funds. We just want to make sure that you transfer those monies into a separate checking account, because even though you may not need it today or day one, you will need those funds down the road in the future. And if you're prepared and have that ready to go, it'll really reduce the stress and just make this investment that much more fun down the road. Next is going to be the annual safety inspection, which is $6 per month. This is where the property manager, Reedy, will go into the property when it's occupied and do a safety inspection to make sure that there's no major lease violations. Like sometimes they won't tell you that there's a dog in the house, right? Well, we want to know that so we can charge pet rent. There's other times we want to make sure that the smoke alarm batteries are working and the fire alarms and the fire extinguisher is there in the property, as well as check on the HVAC filter. So we'll do that once a year for $75. All right, so then diving into the cash flow here, you'll see the cap rates, all cash purchase. So what that means is if you bought this property in cash, your return on investment from a cash flow standpoint will be about 7.26%. But a lot of our clients are going to be taking a mortgage, which is the best mortgage you can get is a conventional loans, 20% down, 30-year AM, 30-year fix. You can get 10 of them per individual with an income. And if you have a spouse and they have an income as well, they can get 10 loans. The key there is we see a lot of people will put both their names on the mortgage. And if that's the case, then you can only get 10 in total. But if you buy them independently and separately, then you can each get 10 properties. Thus, you can have 20 in total. So always be careful about that. So now down here, this is where all the meat and potatoes really are. This is assuming a 20% down. You're taking a mortgage. If you will see here, the cash on cash return is $2,456. So that means that's what we expect and project for your net cash flow to be. This is the money that you could go spend on a vacation, but hopefully you save it and reinvest in more rental properties down the road. That's about a 12.1% annualized return on investment. And this is year one. A lot of other pro formas will have an average cash on cash return to make the pro formas look a little better, because now they can add in rent increases and things of that nature. So always ask, is this a year one pro forma, an average of year 5, an average of year 10? For us, this is year one right out of the gate. Then also cash on cash, that is the best metric to use. So you can compare properties apples to apples, because just if you can get 5,000 a year in cash flow, that could be really good. But what if you have to spend $500,000 to get the property, right? That's not a good deal. So that's why you want to compare and contrast all the money that you have to invest to buy the property and divide it by all of the net cash flow per year that you'll get back. Next is property appreciation of 2,123. So that's the equity that we project that you'll get in 1 year, right? It's a little difficult to access the capital because it's locked in the home, but there's a lot of strategies that you can do, like a cash out refi when you're ready to take advantage of those returns. So this ROI is a 10.5%. I want to make sure you understand that this doesn't mean a 10.5% appreciation rate. This means a 10.5% return on your investment. So this is pretty fun here. We have that's vacancy, property appreciation of 2.5%. So what that means is if the property was worth $100,000, we expect it to appreciate $2,500. So that would be a 2.5% return on investment if you paid for the property in cash. But this is one of the big benefits of owning real estate, is that since you're financing the property, you're only putting 20% down, right? But you get to keep 100% of the appreciation gains. So in this example here, a 2.5% appreciation, which is extremely conservative, right? This last year, Memphis appreciated 14%. So the numbers can get pretty fun. But here, a 2.5% appreciation is $2,123, but you only had to pay $20,000 to get the property, right? Hence a 10.5% appreciation. Or another fun way to do it is essentially take the appreciation rate and multiply it by 5 if you put 20% down, which is technically 1/5 of the property. Then the next one, really fun one, is the mortgage principal reduction. Since you're getting a mortgage, your mortgage is consisted of principal and interest. So interest is the fee that goes to the bank, but the principal, that is equity that goes into the house. It's just locked in the property, just like the appreciation is as well. And year one, you can get just over $1,200 in equity from the principal. But what's really fun is over 30 years on average, that's about a 13.3% ROI. So I just love just having this, mentality of, even if you don't get any cash flow, any appreciation, no rent increases, as long as you have a tenant in place paying the mortgage for 30 years on average, that's a 13.3% ROI. It's pretty awesome. That's massive. So then when you add in appreciation, cash flow, rent increases, the fact that we're in an inflationary environment right now, and one of the best hedges against inflation is real estate, because your mortgage is fixed, but the rents go up in inflationary periods and appreciation goes up in inflationary periods. That's where we get the total return on investment, which is 6,671 projected of equity. And if you divide that by the initial cash invested, which is $20,000, that's where you get the 33% year one projected ROI. Now, I do have to say that these are performance and projections are estimated and subject to change. The provider shall be held harmless if returns are not met. All investments have risks, and investors are urged to perform their own due diligence. Right? We built this pro forma just based off of what the averages are for our company and what we've been experiencing. Next, over here on the right-hand side, the main things you want to look at is just the initial cash invested. So you know how much capital close that you'll need to actually bring out of pocket to purchase the home. And then, oh, I forgot one. There's the tax savings ROI as well. So essentially, the government wants to incentivize us to do the right thing. And what that means is they really do like landlords providing clean and safe places for people to live. So the government treats real estate like a business. And what that means is you can write off these expenses as paper losses against the property. You can also use depreciation because they assume that the value or of the actual home itself is going to be reduced on paper while it's also appreciating in value, which is just one of the best parts of real estate. A lot of people invest in real estate just for the tax benefits alone. So I do recommend you reach out to a CPA to see how they'll actually impact you personally. So that's some of the big ones. From a high level perspective, that's what we bolded. It's great to look at the target rent, the net cash flow, 205 per month, or about 2,500 per year, the cash on cash return, the total return on investment, and the initial cash invested. Those are some of the highlights of the pro forma there. Next, I'd like to dive into the scope of work here. For this scope, we have essentially the high level version here for you to look at. And what this means is this is what we're going to be doing to the property. So you can spend about $10,000 and just put some lipstick on a pig and make the property look pretty and be rent ready, even when it's in this kind of disrepair. But we want to go one step further and make sure that we can add maintenance preventers to the home to reduce your future expenses and to reduce the amount of future maintenance calls that the tenants have. Because the less maintenance calls they have, the more likely they are to stay for a long time. And that's one of the main ways you're successful in real estate. So we go in with the mindset of, how can we add as many, new items as possible? So here, whenever it says roof new, that means we're spending the money to put on a new roof. And for that roof, we're going to do a 30-year architectural shingle roof as opposed to a 20-year 3-tab. So because of our size and economies of scale, we can spend a little bit more money on the front end and get you a higher quality materials. We also will do a full tear off and repair or replace any rotted decking underneath the old shingles. That's really important. You want to make sure they're not doing a layover, because a layover is cheaper and it drastically reduces the lifespan of those shingles there. So if you do a layover, you could put on a 30-year shingle, but it may only last 10 years, right? So that's why we do a full tear off. Just do it properly and do it right the first time. Next will be the heating system and the central air conditioner. These are going to be new HVAC systems. We use Goodman systems here. Water heater is going to be new. Flooring here, hard surface. One of the big things to look out for is carpet in rental properties, right? The two just don't jive. They just don't go well together because no one wants to rent a property that is used when it has carpet that's a little stinky, a little dated, right? The benefit of hard surface floors is that it lasts multiple tenant turnovers. When a carpet, you really need to replace it almost between every single one of the turnovers, especially, when you're in a C or B class, neighborhood. And that's just more expensive. For the hard surface, what we do is we're going to put tile in the wet areas and luxury vinyl plank in the common areas in the bedrooms. And what's great about that is we can pop up individual shingles so you can just replace one little strip as opposed to the entire floor, thus saving you more money. All right, so then appliances here. If we mark yes or no, this is all that's needed for the tenant to move in. So if we mark no, what that means is essentially either there's no space for it, like from a dishwasher perspective. If it's a 3-bedroom house or above, normally they'll always have dishwashers. A 2-bedroom property, the rent's a little bit lower, and sometimes a dishwasher just won't fit. So if we say no here, that's because there's no space. From a range perspective, which is also the stove, that is something where there is space for it, but the tenant will bring that themselves. And that's one of the big crazy differences between Memphis and other markets is that the tenants will provide the majority of their own appliances, and when they break, they're the ones that pay for them. Now, here on the management side, they have a program set in place to help tenants acquire these appliances, as well, to make it easy on them. But it's just one less thing for you to worry about. We're able to rent our properties this way. This is just the norm. And once you kind of get over that initial shock, it's great because it just reduces the things that you need to take care of. We do install a vent to hood on every single property. That's the hood that goes over the stove. And then we don't do the refrigerator. Once again, that's what the tenants will bring. Then here is our projected end date. This is a property that we did in the past because we wanted to show you the before, during, and after. But this is what you can use to gauge to see when the renovations will be done. And then down here are a bunch more frequently asked questions about the management side and the buying process for you to look at and review. Then next thing here is we have the MIP purchase process checklist. We just want to make sure that if you would like to go step by step and check off each one of the boxes, so you make sure that you're always up to speed and doing everything properly. It's exactly what we created the checklist for. Then finally, we have the MAR data. This is the county record tax documents that we have. It's just fun to see the lot size, and you can see the old owner. Sometimes you can see what we paid for the property. You can actually see the taxes here, the tax assessment, appraiser's value, assessed value. We just want to be as transparent as possible, when providing all these marketing materials for you, so you can make an educated decision to see if you want to move forward with the property or not. Once you have chosen to move forward with the property, we recommend on every single one of the homes that you get a home inspection. Always make sure that it's an independent third-party inspector, someone that doesn't work for the actual seller. That's very important. And we'll help you get that home inspection there. And once the home inspection is completed, if you say, hey, Mark, this is the worst renovation I've ever seen in my life. I hate the property. This is just awful. You can cancel and get a full refund of your earnest money. Well, that's written into every single one of our contracts because we're so confident you're going to love the rehab, right? And when you do get that report, there's always 5 to 10 items that come back. Otherwise, the home inspector didn't go. And essentially what we'll do is we'll give that full report to our construction team. And our construction team, they're going to make the majority of all of those repairs for free. Normally, they're just small little cosmetic things. If there's 1 or 2 items that we don't fix, we'll let you know why. And it's mainly because we wouldn't do it on our own rental properties. But ultimately, you have to be 100% satisfied with the condition of the home before moving forward and actually closing on the property. So hope that helps from a little deep dive perspective of 2718 Marlene Street in a C+ neighborhood here in Memphis, Tennessee. So now we're going to go check out the property. Sean's actually at the property, and he's going to go do a little before, during, and after walkthrough, and then show you around the neighborhood so you can get a really good feel of what a C+ neighborhood looks like in Memphis, Tennessee.
Hey everyone, Sean Taggy here, coming at you with another property that we just bought and have started on the renovation. We have our dumpster out here in the front, have just completed the demo on the property, and now we're just rolling along on the paint and everything. This is 2718 Marlene Street, February 8th, a little chilly outside on this Monday morning. So yeah, let's go on in and check out the reno. We'll be showing you the before right now. So please mind our renovation going on. We have our crew in here. But you can kind of see what one of our properties look like before we, kind of like during, I guess, a little bit of the renovation. So come on in and check it out. So come on, check it out. As you can see, there's some rotten wood and a little paint chipping right here. Of course, we check out all the exteriors, fix all those needed issues that would show up on an appraisal or a home inspection. We do our best to make this property the best looking property on the block for the rent amount in the neighborhood. So we just installed a new security door. That's really nice. There's the old one. Okay,
So here we are, here's our crews renovating. Yeah, so here's the flooring, pretty decent shape. There's some chips here and there, so we'll check that out. Looks like there's a window unit over here. So that's a sign that probably if it had an HVAC system that wasn't working or it doesn't have it in there, we go ahead and have HVACs in our property. So we'll be looking into that. Obviously, like making sure all the windows can open and everything like that on our reno. So yeah, we're just rolling along on the paint. Looks like they're just kind of starting it, painting the trim and everything out. We have our workers over here. Hey man. Okay. So rolling along into the kitchen. Obviously, we just tore it apart, getting ready to probably repaint it. Looks like a lot of these cabinets might be salvageable. We'll see on that end on what they're doing on this. And yeah, definitely got some work to do on this property. Here is a den area. So yet again, we'll be totally renovating all this and making sure it's in good shape and safe and all that. So got some more going along over here. Okay, just a closet there and a closet there, so not much to see. This looks like they tore out all the carpet in all the bedrooms. We're gonna put down floor. Our crews are working along on this property, painting. Got another bedroom over here. It's kind of a smaller house. That's kind of how it is for this area and these houses. Kind of definitely a lower class neighborhood. And that's just kind of what it is, but makes for an affordable area and all of that. And this will definitely be one of the best looking houses. I'll guarantee that compared to all the others. Hey man, coming along through here. Here is the third bedroom. Looks like we're tearing out from here, just making sure that plumbing is all good for the bathroom over here. So it's just a 1 bathroom house. We're just gonna come along here. So yeah, this one definitely outdated bathroom. You'll be seeing what it looks like during and after. So there's that. Okay. And let's see, okay, I hope this door opens. Let's see if we can get around to the back. Yep, got a nice brand new, spanking new security door. So that's nice. Ooh, opens good, that's great. So let's step along here. You know me, as I'm kind of in the habit, I just always gaze along up under the gimbals up here. You know, I just always check for that. You know, obviously gonna need a lot of paint and some rotten wood probably needs to be replaced on that. So let's see, yeah, so we can pan around to the backyard. As you see, pretty decent shape, not too much on the backyard, actually some nice space through here. This shed, now this obviously looks like a problem shed to me. We'll probably just tear this out. We do like to leave in sheds if we can. Cause you know, I mean, any tenant would like some extra storage. So if it's in good shape, we'll try to fix it, repaint it, you know, just get it in working condition. If it's rusted and like, if you feel like you're the big bad wolf and could just huff and puff and blow it over, we'll probably just blow it over, you know, using a sledgehammer, and our crews love doing that as well. So yeah, looking at this house, there it is. We'll kind of let you know and keep you posted on the reno during and after. But yeah, checking out from Memphis, Tennessee. Thanks y'all, have a good one. All right, guys. Woo, man.
What a day. What a
What a
day.
great day.
Hope you guys learned something.
Yeah, thank you so much, guys, for checking us out. All the comments on everything from today and all this Sofa Summit. So, yeah, I mean, my key takeaway from today is just seeing Memphis has usually been a pretty stable market, appreciating 3-5% a year. But in this recent year, these recent past 2 years, it's just gone up a lot. So I feel it's really poised to start taking off and have some great returns for our investors and ourselves.
Yeah, and what I love about the infinite banking concept is if you don't want to even utilize that concept for real estate, at least think about it from your emergency reserves, right? Everyone should have at least anywhere from 3 months to 12 months in emergency reserves, liquid cash ready to go. But where are you going to put that liquid cash, right? Well, the vault is one of the best places to utilize that. So you can utilize that for your emergency funds, and you can utilize it just like we do. I'm actually getting
rentals.
approved as we speak right now. He's already got one set up, and you can use it to buy rentals. So hope you guys found some value here in day 2. And make sure you hit that subscribe button. We really appreciate it. Get some sleep because tomorrow is going to be an action-packed day.
All right, see you there.